All right, welcome to video number 5. In this lesson, we're going to talk about the different order types. Just to preface all of this, a market order is an instruction to buy or sell immediately at the current market's price. A limit order is an instruction to wait until the price hits a limit before being executed. Now, if you understand this, you can go ahead and skip this lesson, but if you do not, make sure you pay attention and follow along with the PDF text because this is a very important chapter to have a grasp of. You need to know what the different types of orders are before you start executing said orders. So market order versus limit orders. Market orders are orders that you would expect to execute immediately. Essentially, they say that at the current price, do X. Suppose you're on Binance and you want to buy 3 Bitcoin, and Bitcoin is trading at $15,000. You're happy paying $45,000 for the coins and don't want to wait for prices to drop lower, so you place a buy market order. Now, who's selling the coins, you might wonder? We need to look at the order book to figure that out. This is where the exchange keeps a big list of limit orders, which are simply orders that aren't executed immediately. These might say something like, at Y price, do X. For the sake of this example, another user might have placed an earlier order telling the exchange to sell 3 Bitcoin when the price hits $15,000. So when you place your market order, the exchange matches it with the book's limit order. Effectively, you haven't created an order, instead you've filled an existing one. Removing it from the order book, this makes you a taker because you've taken some of the exchange's liquidity. In the other user's case, however, he or she is a maker because they've added to it. Typically, you enjoy lower fees as a maker because you are providing a benefit to the exchange. We'll talk about the relationship between makers and takers as we move through this lesson. Now, what you need to know about market orders, the basic kinds of market orders are buy and sell ones. You instruct the exchange to make a transaction at the best available price, and you should know that the best available price isn't always the current value displayed. It depends on the order book, so you could end up executing your trade at a slightly different rate. Now, market orders are good for instant or near instant transactions, but that's about it. Fees incurred from slippage and the exchange mean that the same trade would have been much cheaper if done with a limit order. So from here on out, you need to make sure you understand you should be using limit orders and not market orders. Now, let's move on to some other types of orders. So the simplest orders, again, are buy and sell market orders, buy and sell limit orders. If you stuck to these, though, you'd find yourself with somewhat of a restricted trading experience. Instead, you can build on top of these to take advantage of market conditions, whether in short-term or long-term setups. Order number 1, stop loss orders. This is very important. A stop loss is a type of market order that involves you setting an off-book instruction to sell at a specific price, typically when you're already inside of a trade. As the name might indicate, it's designed to protect you from any significant losses. Ostensibly, this appears to be a limit order since you set a price at which to sell instead of executing at a market price. However, the order isn't added to the order book. The trading platform only converts it into a market order when the trigger price is hit. Stop limit orders. So stop limit orders are a great tool for limiting the losses you can incur on a trade. They're a bit like the stop loss order we just talked about, but they incorporate an extra step. Okay, so OCO orders, or one cancels the other. So one cancels the other, or OCO, is a sophisticated tool that allows you to combine 2 conditional orders. As soon as one is triggered, the other is canceled. If we take Bitcoin at $10,000, you could use an OCO order to either buy Bitcoin when the price reaches $9,900 or to sell it when the price rises to $11,000. One of these 2 will be executed first, meaning that the second one is automatically canceled. All right, so time in force. What is time in force? It's another important concept to understand when talking about orders. It's a parameter that you specify when opening a trade, dictating the conditions for its expiration. Good till canceled, or GTC. So GTC is an instruction stipulating that a trade should be kept open until it's either executed or manually canceled. Generally, crypto trading platforms default to this option. In stock markets, though, a common alternative to close an order at the end of the trading day is using this good till canceled. Because crypto markets operate 24/7, though, GTC is more prevalent. So another type is immediate or cancel, or IOC. This order stipulates that any part of the order that isn't immediately filled must be canceled. So suppose you submit an order to buy 10 Bitcoin at $10,000, but you can only get 5 at that execution price. In that case, you would purchase those 5 Bitcoin and the rest of the order would be closed. Fill or kill orders, they're either filled immediately or they're canceled or killed. If an order instructed the exchange to buy 10 Bitcoin at $10,000, it would partially fill. If the entire order of 10 Bitcoin isn't immediately available at that price, it will be canceled. So mastering the types of orders is really vital to any good trader's strategy. Now, whether you want to use stop loss orders to limit the potential for loss, or OCO orders to plan for different outcomes simultaneously, being aware of the trading tools available to you is extremely essential. So if you still are a little bit confused on the different types of orders, I highly recommend watching this video again and starting from the beginning, because it's going to be very, very important for your success moving forward.